Hello once again, guys. Welcome back to Stock Radar. I hope you had a great week so far. And in this video here, we're going to be talking about CVS Health Corp. And that is the stock that you guys voted on over there in the private Facebook group. And we're going to have a new vote coming up this week. So make sure if you guys have a stock you guys want me to cover, or if there's anything in general you guys want me to talk about in this group, maybe you want to talk about a certain stock that has reported earnings, or maybe an update on a stock I've done previously, let me know over in the Facebook group and we can do pretty much anything you guys are looking to hear about. So let me know what you guys are looking for and I will do my best to bring that to you. But first of all, the symbol is CVS on the New York Stock Exchange. This stock trades at a low PE ratio of a 14.5. It's one of these low PE stocks. They have a dividend yield of 2.73%. They have a 102-year history of paying that dividend, but they're currently looking at no growth streak here because they did not raise that dividend over the last 6 quarters, I believe. So there is no growth streak currently of that dividend. The market capitalization is a $75.5 billion, and we're categorizing this as both a growth and an income stock. This is more of a conservative growth stock, though not an aggressive growth stock. It's not like an Amazon. It's definitely a conservative growth stock. Not a lot of growth out of a company like CVS, and this is a 126-year-old company. So a little bit of background for those who are not familiar with this company. CVS provides pharmacy healthcare services, and they operate through 2 segments. Number 1 is their pharmacy services. That's the bread and butter of their business. And then number 2 is the retail and LTC segment. And essentially that's their sales through their stores in terms of when you go in there and you're buying, I don't know, toiletries, toilet paper, cosmetics, makeup. But the majority of the money for CVS is made through their pharmacy services. Now, as far as the size of this company, they have 9,803 retail stores in 49 states, as well as the District of Columbia, Puerto Rico, and Brazil. And this is the number 2 U.S. pharmacy in terms of sales. Now, CVS is actually the 3rd biggest healthcare company in the world, but I wanted to include these other 2 here as well, just to give you guys an idea of the largest and the 2nd largest healthcare companies in the world. And one of the reasons I'm doing this is because I think that pretty much everyone out there should have some exposure to healthcare stocks. And so maybe CVS is not your pick, maybe CVS isn't for you, but I do encourage you to explore some other healthcare investments out there and get some exposure to healthcare in your portfolio. But the world's biggest healthcare company in terms of revenue for 2017 was McKesson Corporation. Number 2 was United Health Group. We already covered them here in Stock Radar, so if you guys didn't check that video out, that might be one you want to look at after this. And coming in at number 3 is CVS Health, the 3rd largest healthcare company in the world. And pretty much what's covered here is what we already talked about before. But one of the main things that we're going to be talking about in this video here is that CVS has entered a definitive merger agreement in December of 2017 to acquire healthcare benefits company Aetna for $69 billion, expected to be completed in 2018. The transaction will help to strengthen CVS Health in its market position. So that is pretty much the only thing going on with CVS right now, is this acquisition of this other healthcare company out there. Other than that, CVS is a relatively boring investment. And I know a lot of people tend to shy away from these boring investments. But one of the things you have to remember is that this is what you call a defensive investment. And in times of market uncertainty, these investments are a lot more durable. And so if you are possibly doubtful about the overall economy or this market going forward, one of the strategies you can follow, and this is something we covered in that bear market investing course, is to get defensive and buy some more defensive investments. And healthcare stocks like CVS are perfect for that because the spending towards these companies is relatively consistent. People are going to be buying their prescription drugs regardless of the underlying economy. And so when you have consistent spending, they're not as heavily impacted by the underlying market or economy. And so they hold up better in a bear market. And I'm going to show you guys that at the end of this video. So more details on this acquisition here of Aetna. Aetna is an American managed healthcare company which sells traditional and consumer healthcare insurance plans and related services. And this right here was an update from the CEO in the most recent earnings report regarding the Aetna acquisition. It says, our solid performance both in the quarter and year to date demonstrates our ability to drive value. It also builds upon a strong foundation for a seamless integration of CVS and Aetna with one goal to transform the consumer healthcare experience and by doing so deliver long-term profitable growth for shareholders. So moving on, let's go ahead and talk about the valuation of CVS stock at this point in time, and we're going to compare them to a couple of different companies out there. First of all, their main competitor is Walgreens, and then we have Rite Aid, and Rite Aid is like a garbage penny stock right now, so we weren't even really able to get much of any information on them. I'm not even sure if they're a profitable company at this point in time, but they're trading at like under $2 a share at this point in time. And then we have Walmart. Walmart has a huge pharmacy business as well, and we're also comparing them to United Health, which is a large health insurer out there, because once they do acquire Aetna, they're going to be more heavily involved in that health insurance business. So CVS comes in at a price to earnings ratio of 14.5, a forward PE of just a 10, and a price to earnings to growth ratio of 1.1. So on the surface, that's a very attractive valuation. Walgreens comes in at a PE of 16, a forward PE of 10.8, and a PEG of 1. Rite Aid, like we said, I don't know if they're even profitable right now. I could not find a PE. They're trading at a forward valuation of 70, and the PEG was not available either. Walmart has the highest price to earnings ratio at a 34, a forward PE of a 20, and a PEG of 4. So based on this here, I mean, obviously comparing Walmart to CVS is a little bit unfair because Walmart is a retailer, but Walmart is significantly higher valued than the shares of CVS in terms of their business. Now Walmart comes in at a PE of 34, a forward PE of 20, and a PEG of 4. And then finally United Health has a PE of 24.3, a forward PE of 18.2, and a PEG of 1.4. So looking at this here, CVS has the lowest price to earnings ratio, the lowest forward PE, and Walgreens has the lowest price to earnings to growth ratio, but CVS is not much higher. And in terms of the highest PE, Walmart has the highest PE, Rite Aid has the highest forward PE, and Walmart also has the highest PEG ratio. In terms of analyst price targets, the analyst consensus estimate is at 86.10, which gives this stock about 17.1% upside based on where analysts are expecting this stock to go. And on the right there, we can see that most analysts are saying this is a strong buy or a buy, with some saying it's a hold, and the recommendation rating is at about a 1.9, which is just above a buy. So what are the pros of investing in CVS stock? First of all, the main one is that this Aetna acquisition will increase the customer base for CVS and allow for more integrated healthcare services, and this is going to allow CVS to become a more diversified healthcare company overall. Second of all, one of the main reasons I like healthcare stocks right now is because of the growing aging population, and this will benefit the drugstores or the drugstore industry as a whole because older people typically use more medication, they're having more frequent trips to the doctor, and this overall bodes well for the healthcare industry as a whole. Third of all, in order to be competing with some of the other e-commerce giants out there, CVS offers home delivery for prescriptions, and you can even pay for same-day delivery that's available in select cities. So they are definitely on top of their game in terms of their delivery and e-commerce channels. And then recently CVS started doing minute clinics as well for basic health issues. You can go in there for things like acne or very basic health problems and be seen by a healthcare provider right at a CVS location. So that's another interesting service they are offering. But other than that, this is a pretty simple and boring investment. And for dividend investors, boring is good. And also for defensive investments, boring investments are good. And like we said, this is a defensive industry, and so this is a good investment if you are concerned about the overall economy and you're thinking that we're going to be heading for a stock market crash or correction. You're going to want to be investing in durable defensive investments, and healthcare is a great industry to be involved with. Moving on now, what are the cons of investing in CVS stock? First of all, this merger with Aetna could be a complicated and time-consuming process in terms of just merging their computer systems and their customer base all together. This could be a very complicated process for CVS. Second of all, one of the reasons why these stocks have gone into a bit of a sell-off is because Amazon is a major threat to the drugstores like CVS. They could be incredibly disruptive to this business. And the main thing here is also the fact that Amazon does not care about turning a profit. If they want to enter the drug delivery space and start delivering prescription drugs to customers, they don't care if they make any money. They'll operate at a loss just to start to dominate that industry. And in terms of what company could lose money longer, Amazon could lose money a lot longer than CVS in terms of prescription drug prices and delivery. So Amazon could operate at a loss and offer drugs at a cheaper price just to build up that customer base and pretty much, take that market share away from CVS. And then another con, this is similar to United Health. The only real growth strategy for a company like CVS is growth by acquisition. The only way this company can grow is by acquiring other healthcare companies out there. And this is really not a growth strategy I'm a fan of because it increases the debt load for that company. But a company the size of CVS doesn't really have a lot of options in terms of how they're going to grow. So this is pretty much the only strategy they can rely on. So moving on, now let's go ahead and take a look at the balance sheet here for CVS. We can see that total assets have grown every single year since 2014 at an average rate of 9.2% per year. And total assets have increased 43.5% over the last 4 quarters. Now this could be a little bit deceiving here. CVS is sitting on $43.8 billion in cash as of the most recent quarter, but that is in preparation for the Athena acquisition. So this was actually debt they have taken out that we're going to see represented looking at the liabilities on the balance sheet. So they didn't just come into this money out of nowhere. This is some kind of loan they have taken out to prepare for this Athena acquisition. Looking at the liabilities here, total liabilities have grown every single year since 2014 at an average rate of 18.9% per year. So total liabilities have grown at a significantly faster rate than total assets. 9.2% growth of total assets compared to 18.9% growth of total liabilities. Not something I like to see on the balance sheet. Total liabilities have increased 68.4% over the last 4 quarters, and that is significantly faster than the growth rate of total assets, which was 43.5%. And a lot of this is because they're ramping up for the Athena acquisition. And the majority of this debt growth for CVS has been long-term debt. Total assets have some coverage of total liabilities at a ratio of 1.36 to 1. As I've said, I like to have a ratio of about 1.5 to 1 or better. So the debt load for CVS is a little bit higher than I'm comfortable with as an investor. And a lot of this is because, like we said, they're ramping up for this acquisition. Moving on here, let's take a look at the total revenue and the cash flows. Total revenue has increased every year at an average rate of 10% per year. So despite the fact that this company really doesn't have a lot of growth opportunities, they are growing revenue at a 10% rate, which is really a strong number. But again, when we dig a little deeper here, we can see that gross profit has increased every year at an average rate of just 4.1%. So when total revenue grows at 10% and gross profit is just growing at 4.1%, that means that profitability has been declining. So cost of revenue is on the rise and profitability has been declining. Not something I like to see here looking at these numbers. You typically want to see gross profit increasing at a faster rate than total revenue, meaning that your cost of revenue is declining. But what we're seeing here is that cost of revenue is increasing. But one of the positives here as well, we're seeing net income has increased every year at an average rate of 12.9% per year. So moving on here, let's take a look at the performance of CVS stock over the last year and over the last 5 years. Over the last year, CVS stock is actually down 6.8% compared to a 17.3% return from the S&P 500. And over the last 5 years, CVS stock is up just 26.8% compared to a 71.4% return from the S&P 500. So over the last year and over the last 5 years, CVS stock has significantly underperformed the S&P 500, and it's been kind of a frustrating stock for investors. So CVS has been a market lagger over the last 5 years, sliding from a high of $110 a share in July of 2015, and ever since then they've been in a gradual downtrend, meaning all they've really had to offer shareholders in the recent years is that dividend, and at a 2.7% dividend yield, it is certainly not a super high yielding dividend stock. And in terms of an income investment, there are better income investments out there than CVS stock. The fear of Amazon disruption seems to be overdone at this point in time. Yes, Amazon could certainly dominate this space if they wanted to and chip into it, but this is going to be years down the road, and I think a lot of this is being priced into today's number, that fear of Amazon disrupting this business. So I think at this point in time, CVS is trading at an attractive valuation. I'm just not really a fan of the debt load of this company or the acquisition strategy where they're growing this company by acquiring other companies out there. Just not really something that I'm a fan of as an investor. But CVS stock and other healthcare stocks are great defensive investments. And like I said, I think everyone should have some exposure to healthcare in their portfolio. And then the last thing I want to show you guys here is why people invest in these healthcare stocks. As you can see here in 2008 when we had the stock market crash, we really didn't see much of a much of a drop here with CVS stock as you would with some of these other cyclical industries. And that right there is a reason why a lot of people like healthcare stocks, is because when the economy tanks, there is still going to be consistent spending directed towards the healthcare industry, and you're not going to have as much of a correction with these healthcare stocks. So if you are looking to get defensive, CVS would be an excellent choice, or other healthcare stocks out there. But for high growth investors, it's going to be kind of a boring investment. There's not really a ton of growth potential there. But anyways, guys, that's going to wrap up this video. I hope you enjoyed it. Thank you so much for watching, and I will see you in the next one.